Hey guys, good evening. Today I'm back with a new video related to the stock market. So without any further ado, let's begin. So now looking at the screen, you might have visualized or you might have thought that I might be discussing about the movies. And if you are, anticipation, or if you are thought us in the similar manner, then you are right. Today I'm going to discuss about the top movie releases which is going to happen in 2021 and which stocks might be benefited from it. Obviously, mostly the multiplexes stock, the PVR and Inox will be benefited from it. And later, after this stock sector, after we go across the the movies which are going to be released by the end of this year or by the end of FY22, we'll then go on analyzing the two stocks PVR and Inox based on their financial data, etc. And then we'll come to a conclusion on which stock is better for investment purpose. So, yeah. So, we all know that at present South film industry is ruling the entire Indian film industry. Well, because of Bollywood, there are issues about nepotism and Sushant Singh Rajput's death and other kids. Lack of talent. Talent is there, like Rajkumar Rao, Ayushmann Khurrana, Vicky Kaushal, etc. But the skillness or the uniqueness in the directors is not there. Unique directors are not there. They are just copying the South movies or the Hollywood movies and they are remaking it. That's it. So people nowadays are becoming more intelligent and they are giving more focus or more interested in watching South movies. So in South, the most anticipated movie all over India is KGF Chapter 2, starring rocking star Yash and obviously Sunil Dutt. So after that, the second most anticipated movie is Triple R, Rajamouli's magnum opus movie, and then Anate, Rajnikant's. You know about Rajnikant's swag and Rajnikant's movie, right? Radhe Shyam is also there. Radhe Shyam is movie by Prabhas. Then Pushpa. Then Beast. Beast is by Nelson Dilip Kumar. Sarkar Vari Patta. Sarkar Vari Patta is by Mahesh Babu, and it is one of the most anticipated movie, and it is a high budget movie. Anate, we all know it. And also along with that, there is another movie called Vikrant Rona in the Kannada film industry, which is going to be one of the most anticipated movie. Okay, and in Tamil, there is a movie called Valimai, which is being casted. Ajit Kumar is being casted over there. So if that movie gets released, then it is going to make. Then it is pretty sure that that movie is going to make around 250 to 300 crores of gross revenue in the box office. So these are some movies. These are some movies which are, which can be considered as some of the most anticipated movies in South India. Along with that, in North India, there are 10 movies. It is being said that there are 10 movies of Akshay Kumar which is going to be released by the end of 2021. So, and they are anticipating that if each movie makes around 100 to 150 crores, then total Akshay Kumar's share of revenue is going to be 1000 to 1500 crores, which is huge, right? Okay. And seeing all this, there is a constant fear of COVID-19 third wave or COVID-19 third wave and closing the houses. And whenever there is an increase in the spike in the cases, the first sector which is going to be affected is the service sector. Out of the service sector, the first sector which is going to be affected is the hospitality sector. In the hospitality sector, everything includes like hotels, multiplexes, etc. So even if so these are movies which I wanted to discuss right now. So if we set this aside, let us come to the point of discussing two stocks, PVR and Inox. First, let us go to the Inox, because out of the two stocks, Inox is the biggest stock as per market capitalization, and today it has rallied of 4%, meaning that the market is going to open up and they are going to get chances. There are high chances that the multiplexes might be opened or the theaters might be opened, and the Indian film industry is set to rule the theaters again. Okay, yeah. Nifty media top gainers. The top gainers of Nifty 50 are Inox and PVR today. It's obviously well known because whenever the pandemic ends down, this is one of the sector which is very likely to get opened. It is very likely to get a relief because most of the sectors have already got a relief, like opening up of the gyms or opening up of the restaurants. So this is the last sector. And coming to this, obviously PVR is the biggest media house. It has about 1.8 lakh seats. Okay, 1.8 lakh seats is huge. And coming to its market capitalization, it is around 8,600 crores, which is none of our concern. I mean, we must just have a look at it, whether it is small cap or risk cap. Based on that, we can assess whether it is a risky stock or a moderate kind of risk. From here, we get to know that it is a mid cap stock. So, there is a moderate kind of a risk in the stock. And promoters have decreased shareholding. I mean, promoters have very less shareholding in the stock, only 18%, out of which, again, they are profit booking. So this is not a good sign for any company as usual. Then mutual fund have increased the increased the shareholding almost by 2.15%, which is a good. And even FIIs have increased shareholding by 4%, which is a very good sign. Institutional investors have increased from 65 to 60, which is a good sign normally. Okay. Coming to this. Here, wait. I'm not saying about the calls, etc. Here I want to discuss about the financials. Okay. One thing which is constantly hovering for this company is the debt of the company, because even if there's a third wave of the pandemic, even if the shops close, even if the company closes, then if the debt of the company is pretty less, then there is pretty much no much worry for the company, because if they are in pretty much need of the money, they can get money from the market, or they can easily get the loan because they have very less debt and they have good assets. But if they already have a high debt, but it will be a little difficult for them to gain the extra debt. So this I wanted to say, if the debt of the company is pretty low, then it is a good sign for the company. So debt of the company is 0.6. Okay, 0.6 is quite okay. If it is equal to 1 or if it is greater than 1, then it's a worrisome sign. Okay, then it is a matter of warning sign for the company. And revenue, profit for the year, if you want to consider, if you want to take it annually, it had incurred 190 crores of profit in 2019. Okay, so 2020 actually the stock has performed, or there was a revenue only in the first quarter of 2020. Yeah, when you come back to the revenue side, you said there was a good revenue, but because of this COVID-19 pandemic, the company had to incur loss. Quarterly revenue was good in March 2020. Post that, the company has not been performing well. Okay, the debt to equity ratio of this company is 0.6. Then let us do an analysis of another stock, which is Inox, right? Inox share price. Yeah, it is going to get loaded. Even this has shown a movement of 2%, which is a good sign. Means if any particular sector is going to get a relief, then obviously the sector will perform well, because the revenue might increase in the upcoming quarters. So now the investors are already discounting it, and they are giving a higher valuations to that price. It is direct, meaning PE we cannot even compare, because the company had made losses in the previous quarters. And let us go to the last side. Debt to equity ratio of Inox Leisure is pretty less, 0.1. This is a good sign. But here the FIs have increased the shareholding, which is a good sign. But the mutual funds have decreased. Mutual fund, if they decrease the shareholding, it is not a good sign. I mean, they have to buy a little amount. But if the promoter itself, if they start to decrease their shareholding, then it's a worrisome sign. For example, if a promoter starts to increase his shareholding, then it's a good sign for the company, because if you have a company, okay, and if you have a plans of expansion, okay, look, for example, if you have a factory in Bangalore, now we are planning to open up a new factory in Delhi, okay, so who will know, who will have the basic idea that you are going to expand? You, right? You as a owner will have a clear picture on when to expand a factory and whether to expand a factory or not, and if you want to expand, where to expand and when to expand. So you will have the clear idea or a clear picture on what to do and at what point of time. So if you are pretty much good about the expansion of your business, I mean, if the business is expanded, obviously the revenue and profits will grow. So you are pretty sure about the company and you would like to invest in that particular stock. So you start investing in your business again. So you'll start purchasing the shares from the open market. So which is a positive sign, which means that this promoters are planning something big in the stock market. So if investors, what you say, shareholding is increasing, then it's a good sign. But if it is constant, then it is not a sign which we have to worry about. Okay, then but the what is a promoter share had decreased from the December to September quarter. That is a sign which you must worry, and debt to equity ratio of this company is pretty less, which is a pretty much good sign for the company. And one more thing, this company also has an equivalent of 1.5 lakh seats. Okay, what PVR has 1.8 lakh seats, this has 1.5 lakh seats. But when we consider the market capitalization, almost PVR is 2.5 times of the market capitalization. And then we come to the profit part annually. It had made 120 crores, so its profit share is almost 2/3 of the PVR share. But the valuations are pretty much high. I don't know why they are considering, because might be because the FPI foreign portfolio investors have invested heavily in that stock, so the valuations might be on a higher side. We can consider it as such. So if you want to consider the valuations of the stock, you can consider, for example, leave aside 2020, okay, consider 2019. 113 was the profit, net profit, okay, and EPS was 14. 113 divided by 14. Valuations are pretty less. Okay, when we consider the same thing with the PVR stock, this was trading around 10 PE. Okay, then if you want to consider about the PVR stock, PVR had a net profit of 190. Okay, 190 divided by 39. So 5 PE. This has been trading around much less valuations, right? Earning per share, okay. Sorry. Earning per share 30 divided by 2000. 30. 30. And then 500 divided by 133. Yeah, this means that the stock had was trading at pretty much lower valuations compared to this stock. So I feel that Inox is pretty much better compared to PVR. So let's wait and watch in the future, and hopefully if the third wave of COVID-19 pandemic doesn't arise, we can have a good thought that the multimedia sector is going to have a good boost or a good recovery, and we can bet major on this. So if you want to invest, I would like to suggest you to invest in Inox stock. So this is all I wanted to say today. So I take a leave, guys. Bye, thank you, goodbye, take care.